Hey traders, David Frost, My Strategic Forecast. You're here for another episode of Common Sense Market Analysis. Today is Tuesday, June 4, 2024. We're looking at a daily chart of the SPY or Spider, which is the proxy for the S&P 500. What do we have on the docket today? Well, we've got a lot of stuff on the docket. We have a lot of information to go through, and it's framed by we have divergences working in the marketplace. Now, they will resolve themselves one way or the other, and we're going to discuss it tonight. Hold your horses, we'll get to it. First, we want to start with the daily chart of the S&P, namely the spiders. We want to get an assessment of where we are. We want to know what the big picture is, and we'll whittle it down from there. We're the umpire calling balls and strikes, so we want to look at the bull case. We want to look at the bear case, leaving our biases at the front door. So what we do know is above 524.61, she's not bearish. Period. Full stop. That is the most recent breakout area. Market runs up to this spot, gets summarily rejected, breaks out above. That creates a breakout area. This works in a variety of different things. Doesn't matter whether it's a stock, whether it's bonds, whether it's a commodity. Doesn't matter whether it's an hourly chart, daily chart, weekly, monthly. Makes no difference. All charts act and react the same way. I prove it to the folks in the live room by showing them this stuff each and every day. A lot of our trades intraday are based on this exact scenario, but using smaller time frames. How you doing? So above 524.61, we're going to say she's bullish. You remember from yesterday, you go to the weekly chart, and all she's really doing is eating some time off the clock above the most recent breakout area, or the former high, if you will, from April. Then she's simply bullish, eating time off the clock above all the moving averages, and from a big picture perspective, riding the trend line. But wait, there's more. Also, remember, we're the umpire calling balls and strikes. So from a daily chart perspective, she could be putting in some kind of a wedgish, a bearish, wedgish formation here after a move down. So a lot of times what you'll find is after a move lower, she puts in one of these bearish wedge situations. Call it a flag. It's not really a flag. You can call it whatever you want. Makes no difference what the name is. The concept is until she breaks the chain, there is likely another leg coming in the southern direction. So now the question becomes, how does she break the chain? What constitutes breaking the chain? Well, let's take a closer look at what the market's been doing, what she's done, what she hasn't done, and whether we think she'll do it in the near future. We want to zoom in a little bit, and what we see here is there was a gap that was left unfilled. So let's narrow things down. The gap is at 529.81. Now, here's the way we look at that. You see the blue line, 529.81. The way we look at that is pretty simple. So they had an opportunity to fill that gap over here on Monday, yesterday, and the choice was made. It's not an accident. There are no coincidences in the market. The choice was made not to fill the gap for whatever the reason. So there's two reasons they would do that, or not do that, if you will. Reason number one is the gap is not the final destination. They're playing games and they're going to trade higher. So if you see them at the gap and they start closing candles above the gap, there's another leg higher coming to where, you might ask? The next place, if you will, in the sequence of importance is around this breakdown candle high, which is also around the trend line, which is also around and also at new all-time highs. So that's what would happen if they started closing candles intraday and then daily above that gap. Okay, that's item number one. Might want to put that on a sticky note. Here's the other scenario. They didn't hit the gap. We could say they couldn't reach the gap, whatever you want to call it. And that's a signal or sign or hint or clue of some weakness in the market by not filling the gap. And if this wedge that we just talked about plays out, then what's going to happen? They miss the gap and they start trading away, and missing the gap was a telltale sign. Now, we don't know which one is going to happen. That's why we have to be the umpire calling balls and strikes, and we have to have the awareness of where these important places are so we know, hey, look, she's getting above this place. Guess what? That's just flat out bullish. Or, hey, look at this. She's trading away. There's no chance she's going to fill the gap anytime soon. Guess what's playing out? The southern direction, the south side lane, the wedge pattern is playing out. So now we've got both scenarios. We've got the bull case. We've got the bear case. We're the umpire calling balls and strikes. What else we got? Well, we go down to a 4-hour chart, and I'm just looking at moving averages for this exercise. The chart isn't going to tell us much other than what the daily chart said. However, we're looking at the moving averages, and we could say, look, above all the moving averages on the daily chart, above all the moving averages on the 4-hour chart, and she's in a bullish formation. So we know above 524.61, she's bullish. Above all the moving averages on the 4-hour chart, she's bullish. Go down even to a 3-hour chart, same routine. Above all the moving averages is bullish. 2-hour chart, you're not going to find anything different. It's bullish, bullish, and bullish. Now you say, well, what if she gaps down tomorrow? Then it's not bullish. Well, that's true. And if she gaps down tomorrow and starts getting below 524.61, we'll know something different is going on. But until that happens, or until she gets below, whether it's a gap below or intraday, 524.61, there's nothing material wrong with the tape. See how we narrow things down? We look at a weekly chart, eating time off the clock. Daily chart, above all the moving averages, above a really important place, 524.61, all is bullish. You look intraday and you don't really see anything different. There are no intraday divergences that we see on the spiders different than the daily chart. So therefore, we can use the assessment of she's bullish until proven otherwise. We're going to take a little detour. Wait till you see this. We're looking at crude oil futures. This morning, the S&P was a little bit quiet. So in the live room, we're going to trade whatever's moving. So whether it's gold, oil, a stock that's on the move, whether it's in the pre-market or after the opening bell, pre-market stocks are put on stocks on the move list. There's stuff that comes up after the open. So we trade a wide variety of things in the live trading room. This was on the board today in crude oil. We were watching it yesterday. I was waiting on a price. I gave it to the traders in the live room yesterday, and this morning they did the deal. So wait till you see this. So we took this trade. A lot of traders in the live room took this trade intraday in crude oil futures. Some traded a USO or any other vehicle that tracks crude futures. But nevertheless, we're looking at this particular chart. And I had two numbers that I gave the traders, 72.78 and 72.60. So I want you to see this. This first hourly candle, the low was 72.61. By 1 penny, my number was 72.60. The next hour, they retested that same area, and the low was 72.77 against 72.78. Funny how that works. We got a nice intraday trade off that. In terms of crude oil futures, if you're not familiar, each dollar in crude oil futures is worth $1,000 per contract. So a rise from 72.60 to 73.60, for example, would be $1,000 per crude oil futures contract. They went to a high of 73.69. We treat it as any other trade. We take a profit as a base hit. Base hits put you in the Hall of Fame, and we hold a trailer because it doesn't cost you anything to hold it, and we see how much they'll give you. Some traders are even holding this overnight. They know where it's wrong. That's a trader's choice. Nice trade in crude oil. We don't discriminate. We took a trade in gold futures today, some traders in the live room. We had 23.37.60. We had a spike the low, hit a number, and rip it back up in the other direction trade. That's one of our favorite intraday trades. We were participants in the commodity sector today, or commodity complex, I should say. We're going to get to the divergences and some other stuff in a moment. Let's circle back to inside the numbers. Let's show you the commentary, stocks on the move. This is what we do each and every day for intraday traders. We had a couple of early pivots. We had one down at 524.65. 526.25 became another pivot later on. There's your bull pivot, 5-minute chart. Right of the vertical is today's activity. You can see they tried to stay above this morning, couldn't do it. They tried it again this afternoon, and then finally they had an end of the day ramp, also known as a jam session. And there's your unfinished business at 528.20. Unfinished business means it's a target, means the market should achieve that or reach that. Doesn't necessarily mean directly it's a reaction in the other direction. Remember, pause the video, read the notes, go back to the chart to double check the work. It's all in here, everything you need from an intraday perspective. If you're an S&P trader, ES trader, MES, options on the SPY, exchange traded products, leveraged products, options on futures, it doesn't make any difference. They're all directional trades. Pause the video, read the notes, go back to the chart and double check the work. Never got low enough to my buy zone. Some traders were able to ride it for a long up north in the later part of the day. We had 3 stocks on the move today: EQNR, GitLab, GTLB, and HOG, which is also known as Harley Davidson. GitLab didn't hit its entry objective. We'll take a look at EQNR and HOG. EQNR first, getting a buzz cut at the opening bell. You could see 2760 was my number. They spiked it. They came about halfway home, also called the midpoint phenomenon, to the next number, and they rallied back to around that number, tried to rally a little bit, gave you some kind of base hit, maybe a bunt for base hit, but all in all, didn't really do much all day. The takeaway is the numbers work. About HOG, here's a different story altogether. 34.75, getting a haircut at the opening bell, spikes the number by a little bit, rips it right back in the other direction on a rocket ride, and you could see here made a high of around 36.20, give or take, in basically a matter of minutes. We had participation in the live room. We had profits running wild in HOG. What about the bond market, TLT? Now, I want to bring this up for a couple of reasons. A, because we have an active swing trade, but this one was also given out to the members in the live trading room, and under this premise. And here's what I did. I brought this up and I said, hey, look, I have a number around here, okay? Now, also, what I think is going to happen, if you squeeze this down, I think what they're going to do is, around this number, they're going to put in a higher low. So what I'm talking about is a low right down here at this black line, and then a higher low, and then a takeoff from there, and that's exactly what happened. So this was an active swing trade from the automagical swing trade, lazy swing trader, automagical system, blah, blah, blah. Jumbled that one up. But it was also given out to traders in the live trading room, but there's a method to the madness. The reason, secondary reason why I wanted to bring this up is because with the bond market rising, interest rates are coming down. Now, wasn't everybody saying just a week or so ago that the Fed wasn't going to lower rates this year? It was becoming unlikely and all that stuff, and rates are going to stay high and all that stuff. Well, all of a sudden, here the bond market starts to rally. Rates are coming down a little bit, but are they coming down because the bond market is smarter than the stock market, and the bond market sees a little trouble ahead? So the bond market's saying, hey, wait a minute, look, if they sell the stock market off a little bit, it's going to force the Fed to rethink their position, or at least some of the Fed governors to rethink their position about when to lower interest rates. So there goes the tail that wags the dog. The tail is the marketplace. The dog is the Fed. Now, this is just a theory. It's a conspiracy theory. It doesn't matter what I think. It doesn't matter what you think. It doesn't matter what cousin Jimmy or Uncle Joe thinks. What matters is, were you in the TLT at about 80, say, what does matter is, were you in the TLT along with us at about $88, give or take? But that other part of the bond market discussion leads us into the divergence conversation. There's always a method to the madness. Before we do that, we'll stay on the automagical lazy swing trader algo system. We had AMT issued a long buy alert at 171.99, right? The low, the recent low. Took profit along the way, turned it into a risk-free, emotionless trade. Final exit today, 201.25. Doesn't have to be a final exit. If a trader wants to hold a piece, that's fine for the purposes of the system and the program. The final exit was today, 201.25. That equals about 29 points, give or take. Pretty freaking good. Lazy swing trader, automagical algo system. On to the divergences, ergo my favorite market leading indicator, Camp IWM. So when you look at the spiders, they were up 59 cents today, 0.1%. It's basically flat on the day, flat to positive, no big deal. But the IWM happened to be down $2.60 some odd cents, or 1.29%. So that's interesting. That's a divergence. My favorite market leading indicator, I'm paying attention to that. We flagged this today in the live trading room. There was an early divergence. We were looking at this and Buttigieg's crew over with Team Transports. We'll get to those in a moment. But right now, we've got an interesting situation. Remember everything with the S&P above all the moving averages? Not so much with the IWM. What happens if you get down to a 4-hour chart, below moving averages, 3-hour chart below all of them, 2-hour chart below all of them, 1-hour chart below all of them. So you can see here, there's not anything bullish at present on this chart. Could they gap up tomorrow morning? Absolutely, but that's not the point. There's nothing bullish now at present on the chart. We do an analysis of the information we have, not projecting what might or might not happen the next day. So if this is my favorite market leading indicator and the transports is my second favorite market leading indicator, a number one canary in the coal mine, again, these two markets are telling us something else. There is a divergence here. You got lower highs. You've got below all the moving averages. You got another big down day, down almost 1% in the transports. So two favorite market leading indicators down, canary in the coal mine down, finishing near the lows. That's not a positive any way you look at it. These are divergences. They will resolve themselves one way or the other. Either the transports and the IWM flip around and start heading up north, or everything else is going to flip around, and this is the telltale sign. This is the clue. This is the hint that there's trouble brewing under the covers, under the hood of the market. Divergences running wild. We got a bond market rallying, interest rates going lower, transports lower, small caps lower. That's risk capital, meaning capital that runs into the IWM, into the small cap space, is risk capital. It's for growth type environments. If money flow is going out, they're coming out of risk capital, out of growth. Just do the math. It's just at face value for me. The folks down at the transportation department is a good proxy for the overall health and theory about what's coming in the economy. That's why I call it the canary in the coal mine. If the transports are performing poorly, that's an indication, it's a clue, it's a hint that the overall health of the economy is likely not what the rest of the market wants you to believe. These are all puzzle pieces. You snap together the puzzle pieces, you begin to see the picture of the market unfold right before your eyes. What about the Q people? Anything wrong here? No, you can make a case you got a little wedge pattern. You can make a case you got a tail. You're above all the moving averages, above the former breakout area at 449.34, and therefore, just like the spiders above that area, there's nothing wrong with this particular market. You take it at face value. Financials. Not in terrible condition, but yet below a couple of moving averages, teetering on the 50. The 50 is not support. We're just using it as a guideline. It's in here. We're using it as a guideline, whether she's above or below. Above all the moving averages, bullish. Starts leaking below, not so bullish. And if she breaks the chain of these higher lows, here's a low. Whoop, wrong tool. Let me do that again. Here's a low. Here's a higher low. Here is a higher low. Technically speaking, there's nothing wrong with this market until or unless she breaks the chain. So this low right here is very important. Write this down, put it on a sticky note. $40.70. You're going to want to know about that number because if she starts trading below and closes daily below, there's likely something brewing on the negative side / southbound lane for the XLF financial complex. Smash mouth, down 0.33% today. We're not going to make a federal case out of that. Above all the moving averages, nothing wrong with this market. Nothing materially changed from yesterday, so we can just leave it alone and run right into... Have I told you how much I appreciate each and every one of you for being here? Anybody who's a member of any of the programs, Inside the Numbers, the Live Room, Lazy Swing Trader, I do appreciate each and every one of my traders. I appreciate the viewers who stop by on YouTube to watch my daily analysis. So for that, I thank you very much. We're going to give it a wrap here. I'm David Frost, My Strategic Forecast. Thanks again for tuning in to another episode of Common Sense Market Analysis.